The information provided on this podcast is for informational and educational purposes only and does not constitute financial, investment, tax, or legal advice. Investing involves risk, including the loss of principal. Past performance is not indicative of future results. Any investment decisions you make are solely your responsibility. You should consult with a professional to determine what may be best for your individual needs. Mergers and acquisitions might sound to some like a job description for a yuppie in a sharkskin suit, but that's not the vibe today. Business consolidation is happening up and down the economic ladder, from community entrepreneurs to banks and Hollywood studios. For the businesses involved, consolidation is often exciting, sometimes nerve-wracking. With the right preparation, though, and the right partners, it can be a win-win scenario. I'm Jake Abler of Forum Communications, and this is Plain Money Talk, a podcast all about your financial life and the things that are affecting it today. A few episodes back, we were joined by Bell Bank's Haley Margetta, who provided an overview of basic pitfalls for small business owners to avoid. In that conversation, we touched on the topic of selling a business, and Haley brought a valuable perspective, but there's a lot more to explore around that topic. Today, I'm joined by Casey Bucher, Senior Vice President and Regional Director of Business Development for Bell Capital Finance. He has a lot of experience in this area, so he's the perfect person to bring us along on a deeper dive into what small business owners should know when considering whether to sell. Casey, thanks for joining us.
Thanks for having me, Jay.
So, we start these episodes with 5 fast questions. We'll ask you to answer 5 questions fairly concisely just to touch on some overview areas before we dive into the topic in a little bit more substance.
Okay.
About what percentage of small businesses will eventually be sold to buyers who aren't family members or employees?
It's a good question, and it's hard to estimate a percentage. If you look at the SBA records, they estimate 10 to 15,000 deal transactions per year. And we don't know how many of those are to family members or non-family members. I think more relevant to our business and what we do in Bell Capital Finance is lower middle market and middle market transactions, which we use a industry resource called PitchBook. They estimate there's probably 4,000, maybe even a little bit more transactions in that range. And I suspect most of those are to non-family investor groups.
So what I'm hearing is not uncommon in any state of the union.
I think that's correct. Yes, exactly.
So are there any types of businesses that are most often sold in this manner, or does it really vary?
I think it could be really any type of business, Jay, as long as there's some type of scale or expansion opportunity with it. So we're probably talking about businesses that go beyond the local presence, right? That could be a manufacturing company, distribution, service, franchise. Any type of business that has maybe a unique product or service that can be scaled or expanded. That's what gets interesting to investor groups or other businesses.
So for sales like this, if you can say in brief, who's buying? Who are the typical buyers for transactions like this?
Yeah, there's really 2 broad buckets, I would say. There's the financial buyers and strategic buyers. Financial buyers are groups like, private equity groups, family offices, what we call independent sponsors who they all have access to capital. They may offer some specific strategic or operating advice or expertise. And they're really trying to make an investment, in that business. And their intent is to sell that business down the road and generate a return on their investment. The strategic buyers are likely companies that offer a competitive product or service, and they want to combine with another business. And they believe that when they combine, they will be worth, together, they'll be worth more than their individual parts.
Well, it's just we're hoping for. It's sort of good overview, help us get to know the topic a little bit more before we talk about it in depth. I have one more quick question for you, Casey. Well, actually, 2 more. I lied. Does selling a business always mean jobs are eliminated?
No, not at all, especially for financial buyers. Again, these are financial investors. They're looking to create value over the long term so they can generate a return on their investment, right? So, a lot of times they're looking at adding people because they're expanding their geographic footprint. They're expanding their product or service line. and they're investing in the business for that future growth, right? So a lot of times a financial buyer is looking to expand and grow and increase their employee count. As it relates to strategic buyers, it's a little bit more of a mixed bag, but if you've got competitors across the street from each other and they merge together, yes, there will definitely be some job losses because you have, you can't have two or three people doing the same thing. That's the whole point. They're getting together. They can squeeze out some benefits by combining.
For people who maybe haven't spent much time thinking about this topic, the idea of selling a business might seem like, oh, it's a cash out, automatic. That's what you do is you're selling your business to make money. But does selling a business always mean profits for owners or investors?
Like any other investment, there's risk, and every business has its own specific risks, and industries have their risks. So, a lot of businesses don't make it, and not all of them are successful. So, yeah, it's far from guaranteed to have a successful exit or sale of a business.
Well, this is all really helpful, Casey. Before we talk about this topic in more depth, let's pause and get to know you a little bit. Where are you based, and how'd you get into this line of work?
I'm based in a western suburb of Chicago. I've lived in Chicago for 26 years, and I've been in banking for actually 28 years, so almost my entire career in Chicago or the Chicago area. And in that time period, I've spent my entire career with lower middle market private equity backed businesses. And we kind of describe that as a minimum of $2 million of annual cash flow, or EBITDA is what we say. So that's kind of the floor, the type of business that we've been working with for the last 26 years through multiple cycles. And I really enjoy it. Now, how did I get into this business? I kind of lucked into it, to be honest. I didn't know what I wanted to do when I graduated college. I knew I wanted to be in business, but I didn't know what business I wanted to be in, right? So I figured I could go into banking and be exposed to all kinds of businesses, industries, and I thought maybe I would gravitate towards a certain industry or business, right? And what I quickly discovered was I really liked the banking aspect because you get a really broad education of all kinds of businesses and all kinds of people, and every day was different, right? I mean, you're kind of doing a lot of similar analysis maybe, but you're thinking about different businesses, different risks, different opportunities. And so that was really appealing. And I decided, at that point, like maybe banking is for me. And I really enjoyed it. You also get to work with really smart people. I've worked with a ton of smart colleagues. You interact with a lot of smart entrepreneurs, investors. It's just a complete education every day, and I love it. So I'm glad I lucked into it, kind of.
Well, it must be gratifying to be in a position to help people at what must often be an emotional and sometimes stressful, but also exciting time for them.
Yeah, I think it's very emotional when you're going through a sale of a business, and it's nice. It's nice to see the finish line and get to the finish line, and usually you celebrate when that happens. Unfortunately, that doesn't always happen, and I'm not always in the room when that breaks down sometimes, but yeah, it's great. It's a marathon, and it's been wonderful.
Thanks for sharing that, Casey. Now, let's start by laying out some of the most typical scenarios in which small business owners are looking to potential buyers. It's not just about getting a business off your hands so you can retire or otherwise step away, although I imagine that is often the case. Among the business owners that you work with, Casey, what are some of the most typical scenarios for bringing in potential outside ownership?
Yeah, there's a handful of scenarios we see more than others. And, one of those is an entrepreneur or a set of family members have built a really great business, and they've built up a lot of wealth and value, but it's on paper, right? It's on paper. And so they realize they want to diversify some of those assets. And a good way to do that is selling some portion of the business. And they might sell 60 to 80% of that business to an investor group, a private equity group that allows them to diversify, take chips off the table, but also keeps them interested. They might stay and continue to run the business. They're going to continue to have ownership, and it allows them for some real upside. right? So that's one type of scenario. Another is, again, a business is really successful. The entrepreneur or family owner they feel like they've maxed out their capabilities. They can't lead it anymore. They're not exactly sure what steps to take. They also, may not want to invest additional capital to expand. Those opportunities might be there for them, but their risk tolerance may be smaller than what it used to be. And so they don't want to do that by themselves. So they might, again, go out, look for some investor capital, and be able to share in that risk and reward, right? So they'll take some chips off the table, continue running the business. But now they have not just really smart people shoulder to shoulder with them, but they have additional capital in the business to make those investments and execute on those. And there's so many others. You mentioned, retirement. There's some their family members just don't want to. There is no family member to transition the business to, or family members not interested. There's health issues sometimes. There's partners who disagree. There's just life changes, right? And a lot of those lead to some sort of sale transaction. And we've probably seen them all.
That's a good point of clarification that selling a business at this scale is not necessarily like selling a car where you sign the title over and that's it, you walk away, you're done. That there are ways to sell part of the business, to remain involved in various ways. And so that it seems like there are a lot of options potentially for people who are looking to bring in some outside ownership.
There's tons of options. There's tons of capital out there. It's kind of finding the right solution for you and what you're looking for. And sometimes that might change. You might think you're going one way as an owner and then what you want, and then you get into this process a little bit and you're like, you know what, maybe I want to go down this path, so it's emotional. It's a long journey and it can take a lot of twists and turns.
To that point, to helping people find the solution that's right for them, what trends are you seeing right now, Casey, across deals? What should potential sellers be aware of in this particular economy?
Yeah, depending on how you look at that, there's tons of trends. I'm going to speak a little bit about what I see from my deal perspective. There's tons of capital out there, institutional capital that's been raised, and there's estimates probably, over $1 trillion of uninvested capital, but it's been committed to go into private equity or that type of business. So that trend has been in place for probably decades now, and it just continues to increase. And that means there's just a lot of capital out there, right? And there's going to be a lot of opportunity for sellers and owners of business to utilize that. So, but what we're seeing on a deal perspective is a lot of times investors, they'll go in, they'll kind of overpay for a business if it's a really good business and it's a really good management team. And because they want to establish a platform, and their thesis will be, okay, this is a great business, a great team, and I can expand this, right? There's opportunities to grow this business organically. There's opportunities to make acquisitions. And they think, okay, I might go in a little bit, pay a little bit more than what I maybe should or what it's worth. But as I grow this business and as I add other complementary businesses along with it, I can buy those maybe a little bit cheaper and effectively blend down that overall purchase price, and get to a point where the company is more valuable, but by doing it in pieces, it allows them to invest less capital, I guess, or pay less over time. So that's a trend that we've been seeing, and I think that will probably continue. Another trend basically on the deal side is the diligence process. It is an exhaustive and extensive process. And I don't think any business owner wants or enjoys going through it. But, you have investors, financial buyers specifically, who they're going to pay a lot of money for your business and they want 110% conviction. They know exactly what they're getting, right? So they spend a lot of time, a lot of effort. They dig through everything. And it's painful. There's no other way to say it. So the owners should be aware of that. And I guess another one is these transactions are taking longer to close these days. And it's not just because of that increased diligence process that buyers are going through. There's just we live in such a dynamic time right now, both from a macro and micro perspective. I mean, you think about all the challenges business owners have on a daily basis, whether it's AI, tariffs, conflict in the Middle East, fluctuating oil and commodity prices, inflation, right? Interest rate changes potentially. Like it's just so incredibly difficult, I think, to run a small business that, it's hard. It takes a long time to go through a deal process, and to stay consistent, given all those challenges, is really hard. And that's what a lot of investors want to see, is consistency. And it's tough. It's just really challenging. But I don't know that that's going to change anytime soon. So that's a trend.
Yeah, good to know. Well, Casey, part of what you just said touched on something we heard from Haley, which is that it is good to keep your house in order in terms of keeping your books straight and make sure your accounting is accurately representing what's going on with your business. If you let it get too mixed in with your personal finances, or you're not as scrupulous as you could be about your accounting, that's just going to create complications down the road when you come to a juncture where you need to provide an accurate depiction of what's going on financially with your business.
Absolutely. I think being prepared is critical. And, you need to be prepared for an extended process. So you probably need to start earlier than you think you need to start. You can always pause, right? You can always sort of pause and take a breath and decide if you're taking the right path, or if you need to turn or whatever. It's really hard to accelerate, and speed up a sale process. That's tougher. Maybe a little less likely to result in success. But yeah, you're absolutely right, Jay. The sophisticated investor, they want to be your partner. These private equity groups and financial buyers, they don't really want to run your business. They want to partner with you. They want to understand your cash flow, how sustainable it is, how it can expand in the future. And you need to be able to articulate that to them. Part of that is being organized and prepared. And that should translate to a good result.
Great. Before we take a break, I have one more question for you, Casey. What are some common misconceptions that you hear about the process of selling a business? Are there any myths you want to bust? Pick up a trope from earlier in this podcast series.
I mean, I'll touch on a couple. I think one of the main ones is just anytime you want to monetize any investment, right? Timing, it's just not realistic to time. Let's sell at the peak, especially in a privately owned middle market, lower middle market business. It just takes a really long time. You're not gonna be able to time it. So I would just focus on doing the fundamentals, and executing your fundamentals on a daily basis. And you time it, you sell it when the time is right, based on what your personal needs are, not what the market necessarily tells you. So don't try to time it. I think another misconception is that private equity buyers, financial buyers are, they have this reputation of maybe being heartless or ruthless. And I don't think that's true. Of course, there's probably, everybody's different. Everybody has a different philosophy or investment profile or process, but there's some really good private equity financial buyers who understand that relationships are important, people are important, culture is important, and that all drives success. They're looking for partnerships, and you got to have the right approach when you do that, and you value those things.
Well, now this is in turn is making me think of our earlier episode where I talked with Brooks Bollinger, who came into banking after gaining a lot of experience in football. And we talked about some lessons that have carried over from his football career into his current career in banking. And one of them was focus on the fundamentals. That's a timeless lesson, it seems.
If I told you how many times I heard the term block and tackle over my career, it's a lot, and it's really that's what it comes down to. He's right.
We are in the upper Midwest here, so the sports metaphors hit home.
Yeah, true. I will say one more thing, Jay, on that last question is, if you're an owner and you're selling your business and it's a really good business, you focused on those fundamentals, Um, you can dictate the process as the owner, right? It's your business. You can dictate it. So figure out what's most important to you, right? Is that the legacy of the business? Is it employee retention? Or do you want to just maximize value and take as much proceeds as you can? Like, there's no wrong or right answer to any of that. I think, you dictate the process, and as long as you're transparent about it, I think you're in fine shape.
I think that's the beauty of being a business owner is you own the business, and for better and for worse, you have a lot of leeway in terms of the decisions you make throughout the process of owning and perhaps then selling that business.
Absolutely, for sure.
Well, thanks for everything so far, Casey. We'll be right back, but let's take a quick break to hear from our sponsor, Bell Bank.
Behind every moment, there's a feeling of happiness, of security.
Keep going, pedal, pedal.
Behind every dream,
Order up.
there's a spark.
We got the house.
With every challenge,
Just one more step.
there's a safety net. Behind every victory,
Yes!
there's a team. Behind every moment, there's Bell Bank. Member FDIC, Equal Housing Lender.
And we're back with Plain Money Talk and Casey Bucher. So, Casey, I want to sort of take a turn for a moment and talk about something that may seem a little tangential, but is certainly related to what we've been discussing. So, one way or another, anyone selling a business is certainly going to be dealing with a bank. And part of what's happening with today's economy is affecting the banking sector as well, where a lot of people are seeing their financial institution merging with another. So, Casey, you have firsthand experience in a bank transition. What can you tell us to help us understand why these consolidations are happening and what they mean for bank customers?
We could talk for a long time on this, Jay, because I've been through a few of these myself. But I think to answer your question, there was a lot of new regulations put in place after the great financial crisis on banks. And we've started to see those be reduced or removed in the last several years. And so what's ultimately is happening is that's freeing up capital on the balance sheets of banks. And I think the question for that management team at that bank or board or whoever is, what do I do with that capital? And there's a couple answers to that, but one of them is, I'm going to go make some acquisitions. I'm going to go create shareholder value by acquiring another bank. And, we touched on this a little bit earlier, but like banking is maybe a little bit more commoditized than a lot of businesses. And there's a lot of geographic overlap between banks. If you're in a major, metropolitan area, even now, you might see a bank on every corner, right? And it's a different bank. So you talk about strategic acquisitions. This is where it comes into play, right? One bank acquires another one, and there's just a lot of expenses they can reduce. So that comes in the form of, locations. It comes in the form of people, right? So in theory, you're buying customers, you're buying a book of business. You can reduce your staff and reduce your costs. You get a return on that investment, right? So I think that's why. Or those are a couple of reasons why we're seeing what we're seeing in the broader environment. Another part of it is just the costs and pace of technology, right? Bigger institutions have way bigger budgets. They can invest in technology much faster and much broader than smaller institutions. And so, those smaller institutions have to have a decision to make. Can I continue to invest? Am I going to be able to invest where I need to, how I want to sustain my customer base and to bring in new customers? And I think maybe a lot of them, maybe there's a line of demarcation somewhere, but a lot of them decide we can't. We just don't have that budget, so we're going to be forced to sell based on the technology costs by themselves. So as it relates to kind of the customer, I would say there's a few things to discuss, and I'll speak from my experience here. When two banks come together, there's a winner and a loser, and it may be obvious if one of the banks is 10 times the size of the other one, but sometimes a transaction, a merger is publicized, and it's like, we're coming together, we're going to merge into one institution. I just think there's still one bank wins and one bank loses. And what I mean by that is there's always one bank. When you get in the weeds, it's their policies, it's their procedures, it's their systems that will generally, survive. And that means you've got an entire company, an entire bank of employees and customers that have to migrate over to those other processes and systems. And I think that creates a lot of, poor morale and service and delivery. And, it's not just from the losing bank, so to speak. The winning bank, also, their employees and their customers suffer sometimes because all of a sudden now that bank's customers, they're getting a whole bunch of new customers. The other bank who was acquired, those employees have left. So now I've got a whole new set of customers, and I don't know them, and I don't know how to service them, right? And so it's frustrating, I think, for everybody. And I think most customers, they want to choose who they bank with. You're being forced to change banks and go through a process, and I think that opens the door for a lot of consumers and businesses to say, well, if I'm going to switch banks, if I'm being forced to switch banks, why not switch to someone that I know or I want to work with versus being told where to go? So, to me, that's how it usually plays out. And, from a shareholder perspective, maybe it makes sense, but it's really disruptive at the consumer level, whether, a retail banker, whether on the commercial side, the wealth side, mortgage, anything. It's challenging, and but it's going to continue, I think, for the foreseeable future.
Is there anything that customers can do or should keep in mind when choosing a bank or dealing with their bank in this environment that will help them sort of know how to proceed if their institution merges with another?
Unfortunately, I don't think there's a whole lot you can sort of prepare other than trying to have a good relationship with your banker or your bank. But, when these acquisitions or mergers are announced, it's not like they don't happen overnight. It takes some time, and it takes a lot of time for systems to be consolidated and back offices to be consolidated. So I don't know, you might want to be thinking about, well, if things don't go smooth or if I don't get the communication that I want or I need, like maybe I should start organizing and go bank somewhere else. If I know I'm going through a transition, might as well take that opportunity to be somewhere I want. But it's really hard for a consumer or a business to dictate anything other than what they can. They're not going to be able to do it at that bank level.
That is fair enough. Well, thanks for talking about this topic, Casey. And we'll steer it back to this episode's topic of businesses being sold. So let's get into some nuts and bolts here. So when I spoke in an earlier episode with Bell Bank's Brooks Bollinger, just mentioned a couple of minutes ago, he talked about the importance of wise counsel. So it's a team of advisors who will provide key insight on different aspects of your financial life. So for a small business owner considering a sale, what does that team look like?
So, Brooks is absolutely correct. And I'm gonna suggest something maybe you don't expect, but I think it's super important based on, the hundreds of transactions and companies I've seen in my career. And I'd say the first step for an owner is making sure you assemble a really good management team within your business. It's depending on the size of the business, that might be one other person, it might be 5 other people. I don't know, but I think when you're going through a process, as we discussed, it's lengthy and it's exhaustive, and you need people you can rely on inside your business to run it day to day, or at least, be very valuable to you as the owner to be focused on maybe the transaction or some other strategy. So I think it's really important to get a fundamental key set of managers or employees, at least, in your business, And that is, again, a fundamental aspect of the whole process. It's also going to help during this diligence process that we talked about that's extensive and exhaustive because, if the owner is comfortable and they bring in and let the key employees or key managers know, like, hey, I'm contemplating this transaction, they can help, right? There's going to be tons of data requests, tons of questions to answer, and having more resources internally is going to help that owner ultimately progress down the path, right? So I think that's step one. I think another step, and you touched on this, Jay, already, but having a really good accounting firm in place for several years, making sure you're tracking all the expenses that may be non-business related. So, a buyer isn't getting those expenses, or they could be carved out from the transaction and from the value of the transaction. But you want to just be really prepared. You want to have a good accounting group, maybe somebody who has a tax group, accounting firm that has a tax group, because taxes play a big role in this at the end of the day. Preparation, organization, record keeping, all that stuff is super important from an accounting group. I think you also want to have, again, this is probably business size dependent, but a really reputable business broker or investment bank as your advisor to help you sell. That should be a company with relevant and successful experience for your industry, your type of company. They're going to give you a lot of really good advice on what to expect and how to prepare and all that kind of stuff. But, do your diligence on this group. You're not forced into choosing somebody. So take your time, talk to groups, figure it out. You're going to get a lot of diligence as an owner done on you and your business. So you want to turn around and upfront, do some diligence upfront by yourself and on them as well, I should say. So I would say that. I would say you, of course, want to have really strong legal counsel. If you're selling to a financial buyer or a strategic buyer, they're going to have very experienced counsel on their side. Attorneys who are dealing with mergers and acquisitions all day, every day. So you're going to want to have somebody who knows the ins and outs, the nuts and bolts of, the little nuances of a transaction. Again, you don't have to engage somebody like that a year or years in advance, but maybe get a short list or do some research and figure out, like, okay, who are the firms that experienced in this space? And then you engage somebody at the right time, right? So that's helpful. And then, a wealth advisor is also very helpful, trying to understand and plan, like, when are you going to receive proceeds? How do you receive those proceeds? Maybe there's pending tax changes coming up, and maybe that dictates, do I want to close this year or do I want to close next year? And so all those people are going to be important members of the team. But because this isn't really a linear process and it's going to take twists and turns, you don't have to add that team all at once. You can add as you're going, and as things progress and as it gains momentum, then you can start adding those team members as part of your wise counsel.
Well, yeah, you started mentioning the importance of having good internal management and reliable employees who will give you the information you need. And I'm just thinking, I'm telling on myself a little bit here, but I'm thinking back to my first full-time job out of college. It was not with a for-profit business. It was with a nonprofit, but I imagine this sort of thing could happen at a for-profit business. The executive director came back one day, and part of my job was processing payments. And I said, "Oh, how'd the board meeting go?" And he said, "Oh, it was rough. They really had a lot of questions about, what's in our bank account." I'm like, "Oh gosh, I'm sorry I had to deal with that." And he said, what's that pile of checks on your desk?" I was like, "Oh yeah, I just haven't got to those yet." He's like, "Jay, that would have been really good information for me to have when I was talking to the board, that Jay has a pile of checks waiting to be processed on his desk." So yeah, I was not an MVP for the team at that time. Hopefully I've progressed professionally and I've moved into a different field, which is maybe for the best for me. But to that point, I was, like I said, I was new out of college. I was pretty cheap probably for that business to hire. So hiring good people, whether those are internal people, employees, managers, or external people who are going to be part of that wise counsel, it's not free. It's an investment. And like any investment, as we've been saying, there's an element of risk. So Casey, what would you say to help business owners understand the nature and importance of that investment and the team that they're building?
Yeah. Remember here, I'm talking about businesses with a little bit of scale. And so, we probably see companies with valuations of on the very small side of 10 or 12 million and up from there. Right. So, I think as it relates to the team being assembled, the management team is one thing that's inside the business. The business has to be able to support them, and they should be able to generate value and increase the overall value of the business. But as it relates to your outside advisors, I would say that again, they should be able to generate a return on the investment that you provide them. So what I mean by that is nobody likes to pay fees. Like nobody likes to pay their lawyer their fees and their, any advisor fees. But you have to be really careful in these situations because you can generate a return on those fees. And what I mean by that is if you hire the best, you hire the right people, the right groups to represent you, to advise you, you might spend several $100,000 on fees. But if that translates to a sale transaction where you receive $1 or $2 million more in proceeds because you hired the right people, right? You may have made a 5 or 10 times return on your investment versus hiring somebody an advisor who's competing on price or something else, right? That may not do a great job. Or worst case, they might take a lot of your time and they may never get you to the finish line because they've never done it before, or they don't have a lot of success. So I know we're all hesitant to pay fees. I'm the same, but you kind of have to zoom out and figure out like, can I get these advisors? Which advisors are going to provide the most value, and they'll pay for themselves and then some.
Sure. So then these advisors can certainly help business owners understand key aspects of a potential sale, put them in a position to succeed. Then in turn, what do business owners need to turn around and communicate to their own stakeholders and potential buyers as this process moves forward?
Yeah, I mean, it's so emotional, right? Selling a business. I've never been in that position, but I know it has to be. And so I think communication is really specific based on that situation of that owner, those stakeholders, employees. I've seen communication to employees done a lot of different ways. Most owners don't want to communicate to the broader set of employees about a pending transaction because there's so many twists and turns again. Like you never know if it's going to close or if it's going to happen. And so why introduce that anxiety in your employee base until you're very confident or that something's going to happen or it has happened. So I think that's, it's situation dependent, but ultimately I think if an owner can go to their employees, customers, whoever you want to say and say, listen, be very transparent and say, look, this is why I'm bringing on a partner or I'm selling majority of my business. Those are a lot of different reasons you can provide, but just be honest, be transparent. And I think at a lot of levels, all those stakeholders and employees will understand like, well, this isn't going to last forever. There's got to be a plan here. And so I think it's helpful. The owner who can stay involved even at a high level, I think that helps too. Hey, I've sold most of my business, but I still have some portion of it, or I'm going to be on the board, or you're still going to see me walking around the floor. All that stuff I think helps put everybody at ease because you really just don't want to change anything. That the investor group or the buyer doesn't want to change anything either. They want everything to keep going, do no harm. And so, I think it's communication, it's honesty, and, ultimately the new owner or the new majority owner, whoever it is, this private equity group they want a partnership. They need to partner with the management team, with that owner to have success. So, everybody needs to be aligned, and that comes back to that communication and transparency.
Totally. Well, thank you, Casey. This is all really, really helpful and interesting. And I don't want to take too much more of your time. So, getting close to wrapping up here, in your experience, what does a successful business sale look like? And on the other hand, what causes transactions like this to be challenging?
Yeah, again, we talked about so many different challenges with running a business today, you know, both things you maybe can control and a lot of things you can't. So adding that management team, trying to minimize the challenges outside of the business, that comes along with the process is probably great. Getting those resources in place, your team in place, be as prepared as possible, and be prepared for stops, starts, twists, turns, everything. Remember, the best advisors probably cost the most, right? And that shouldn't scare you off. It should, you should do your diligence, but pick the best, and you may have to pay for them. Again, start way in advance and be really transparent with what you want out of this transaction as an owner, and try to find somebody who's aligned, or a group or an investor base that's aligned with those interests and that methodology, because that will give you the best chance of success to get to the finish line, but also the best chance for that business to be successful on a continuing basis.
Well, thank you, Casey, for all of this information. This is a lot to think about. I'm sure this will really help a lot of business owners who are considering moving through these steps, or maybe have already started moving through these steps. We do have one last question that we ask every guest on this podcast. It's always the same. What's one piece of financial advice you wish you'd been given a long time ago?
So I'm going to maybe change this a little bit, because I was given some advice on the very first deal I ever worked on, 26 years ago or whatever it was. And there was a patriarch of a family business that had just completed a successful sale transaction. And, we were at a post-closing sort of celebration, and he made some remarks. And one of the things he said is, as it relates to business relationships, I'm going to paraphrase a little bit, but he says, as it relates to business relationships, you got to look at them like you're wearing bifocals. He's like, it's important to look down, look down at the numbers in the spreadsheet and all those numbers make sense and all that kind of stuff. But you also have to be able to look up, and you have to look across the table, and you have to look in the eyes of those people sitting across from you and your partners, if that's ultimately what's happening. And you have to be comfortable there, right? The numbers can make sense, looking down can make sense, but if you can't look across the table in those eyes of your partners, you don't feel good, something's not right, it doesn't matter what the numbers say, right? So partnerships matter, relationships matter, and I've always remembered that, and I'm appreciative that he was able to share some of that wisdom with me. And, I think it's something to always keep in the back of your mind about those two elements of any sort of a relationship.
Yeah, absolutely. It sounds like that is good advice in your line of work, but also good advice in a wide range of relationships that we have in life. So, Casey, thank you for sharing that. And thank you for sharing your time with our listeners here on Plain Money Talk.
My pleasure, Jay. Thanks for having me.
Absolutely. Quick note about myself. This is my last episode as host of Plain Money Talk. I am moving on, and you'll have a new host next episode. I think you will really enjoy her. I'm really excited to hear what she brings to the podcast. I will certainly be listening, because I know that the experts at Bell Bank have a lot more insight to share with all of us listeners to this podcast. Now, before we wrap, quick note from our partners at Bell Bank. As we've heard today, consolidation is reshaping the business landscape, and for many business owners, that means thinking about how and when to exit. Bell Capital Finance provides financing for lower middle market businesses involved in an ownership transition, and is committed to supporting investors, owners, and management teams across the country. To learn more, visit bell.bank/capital-finance. Bell Bank, member FDIC.